With that in mind, we are going to bring in Brad Hintz of Sanford C. Bernstein. He covers Goldman Sachs and Morgan Stanley. He's joining us now to do a little bit of compare and contrast. Brad, also, though, to talk about what can President Obama say, if anything, today that would either make the banks feel good or destabilize them as far as reform or potential reform is considered?
Well, I think we know reform is coming, and you know, the reality of it is going to show up with President Obama here. He's going to be talking about how we need it, and of course, from the point of view of the street, this is going to have a very negative impact in terms of virtually all the trading businesses, because you're going to have more capital per unit of assets. You're going to have lower leverage for them.
Is that a bad thing, though?
Well, not from a systemic point of view, but from an investor point of view, it certainly means the ROEs are going to go down. And then the other one that you're going to have is derivatives. And derivatives are, a good rule of thumb is about 15% of the equity revenues are derivatives, about 20% of fixed income, pardon me, of the 15% of fixed income is revenues, 20% of equities is derivatives revenues. These are higher margin businesses, and you can almost cut that in half if it goes through as it is currently considered.
I think that's the huge fear, and in your recent Goldman note, you said really the quarter was due to, or at least the upside versus your estimate, was due on this healthy bid-ask spread. Is supporting healthy bid-ask spreads supporting opacity or protecting opacity? Is opacity basically measured by the bid-ask spread in derivatives?
Well, derivatives have very wide bid-ask spreads. Fundamentally, the derivatives business is one of entering into a contract that, one, you're going to have to pay to get out of, because only you and I can execute that contract. And the other one is, I'd really love for you not to have taken a course in Black-Scholes, in other words, pricing options, or knowing how to price a swap. So as a result, the inability of a client to take apart a derivative means that the bid-offer spreads are relatively
essentially
attractive.
You're saying it's the position of the banks to take advantage of ignorance.
Well, in many ways, the market is like that, too. Now, bid-ask spreads on the trading side is really quite different. We've seen trading come down pretty substantially. So the cash markets are liquid.
If you actually look at Goldman's earnings, I mean, nothing in the earnings were good on the commodity side of the business, cash trading on the equity side, or even in banking, which is turning into a bit of a commodity. The real fat in that Goldman earnings report was on the bid-ask spread in untransparent, dealings or markets that need to be re-regulated. At least that seems to be the political message.
Well, that's the political message. The reality is this was fixed income trading largely on governments and credit, and derivatives are part of the whole thing. Right. The derivatives business does not drive the profitability of the trading business. It's an important part of it, but not the only part. So if I take derivatives away, it doesn't mean trading goes away. It just means the overall return of the trading business drops.
And that's the political danger, Brad, because politicians have no understanding of the mathematical mechanics of all of this. They just understand the political blow that they can deliver by saying it's transparency versus opacity, and derivatives are opaque.
Right. And, frankly, the opaque markets, and arguably, by the way, the opaque disclosure of the brokerage firms has hurt them.